Good morning or good afternoon, everyone, depending what part of the country you're in or what part of the world you're in, because we get listeners from all over the place. Thank you for joining us for today's training on mastering real estate loan refinancing. What we're going to be discussing here is basic ways to convey the value of a refi to your borrowers, and also for us to be able to add value as a loan consultant. I always mention that at the mortgage calculator, we like to train our loan officers to be loan consultants and not just to be an application taker. That's a great way to differentiate yourself from the thousands and thousands of loan officers out there. Anybody can offer a rate, but not everybody can close the loan and close the loan on time and in the agreed terms. So let's get right into it. Mastering real estate loan refinancing. So, what exactly is a refinance and why refinance? Right. Well, refinancing is the process of taking out a new loan on a property to either pay off an existing loan or tap into the equity of a property, right? So we would either be doing a rate and term refinance, just refinancing the loan, current loan, or we would be doing a cash out refinance where our proceeds are going to exceed what we owe. And if it exceeds it by a certain dollar amount, depending on the guidelines where you're sending the loan, it would be considered a cash out refinance. So, what are the key reasons to refinance a real estate loan? We would be looking at either lower the interest rate, uh, reduce the monthly payments, access the home equity, and consolidate debt. Right. So, a lot going on there, especially with our high volatile market right now with interest rates. So, four good bullet points there that we're going to expand on now. So, when does refinancing make sense, right? This is one of the key components that you need to be able to convey to your borrowers, right? Uh, because the ideal timing for refinancing, when it makes sense, is when the refinance aligns with the borrower's specific financial goals and circumstances. Now, I highlighted that or highlighted that in red so that you could, obviously I want to point it out because this is so important. This is where it all begins. This is where when you are initiating that initial communication with the borrower, that initial sales call, where you're finding out, gathering details, talking to the borrower about their credit, talking to the borrower about their income, about their assets, about the property, and talking to the borrower about the objective that they're looking to meet with the refinance. I mean, we cannot assume anything here, right? We cannot assume that why would they want to refinance if they currently have a 5% rate and the best rate I can get them is 6.5%. Oh no, it's not going to happen. Well, how would you know, right? You cannot assume what the objective is for the refinance. Maybe they're overloaded with 32% interest rate credit cards, looking at a possibility of never paying off those cards or maybe paying them for 28 years and hundreds of thousands of dollars in wasted interest payments, reduced disposable income. So obviously refinancing even into a higher interest rate than they may currently have would make sense. But The different, I'm getting a little bit ahead of myself there because we're going to cover that in depth in the following slides. So the scenarios that may spur a borrower to want to refinance are several, right? You could have interest rates that have dropped, right? I mean, right now we're getting a lot of volatility in the market. Some days you see a 10-year drop in a 2 or 3 day span could drop 20, 30, 40 basis points. So that obviously could be an alert for some people who've been waiting to refinance. Maybe the borrower's credit score is improved, right? They've been working on it for 6 months. Now they just got the last alert. Their credit score is a 740. They now qualify for that particular program or maybe for the preferred rate that they've been looking to get. They may have a change in financial situation, right? Like some kids going to college. Somebody could be ill, hospital bills, looking to retire, cash out on some money so that they can just have money in the bank, in preparation for retirement or different things. Reducing the loan term, that's a really good one, going from a 30-year loan to a 20 or a 15 or a 10-year loan. In those shorter amortizations, you pay a lot less interest and a lot more principal. Or, like I was talking about earlier, the interest rates on their consumer credit has risen. Now they're at, 28, 30, 32%. When they initially give you those credit cards, obviously it's, 0% interest for 12 months, 15 months, 18 months. Then after that, maybe it's 14, 15, 16, 18% interest. The issue may be if somebody's balances start going up on all their cards, credit scores drop, or they miss just maybe one payment on one card, all those other credit cards get wind of that information. Next thing you know, they're all increasing the interest rates because they are going to state that it's a higher risk situation that the borrower is currently in. And if you read those credit card statements, those credit card agreements, you're going to see that at any given time, they can raise their rates if you have issues with another card. And then they raise it to the default rate, the maximum rate, 28 to 32%. So that definitely is going to motivate somebody to refinance, even if they have a low rate on their current mortgage, if the only option to get money is a first mortgage. We have second mortgage options, like as well, but that's a that's for a blended rate presentation there. So let's talk about the benefits. Expand on the benefits a little bit there. I listed the bullet points there, but expanding a little bit. Now, when we're talking about lowering the interest rates here, is when analyzing the benefits is what's going to allow you to properly convey the benefit to your borrower. Again, remember, loan consultant, you want to analyze, you want to break it down in a quantifiable manner so that people can make educated decisions. So if you're going to lower the interest rates, benefits you're looking at is reduced monthly payments. Another benefit, less spoken about, but this is the one where you really break it down to them, a more favorable loan amortization, right? As you reduce the rate, the payment distribution is going to change. You're going to be paying more principal and less interest within the payment um, when you reduce the rate. And obviously, both reduced monthly payments and more favorable loan amortization are going to result in long term savings. Now, our debt consolidation benefits, that's when we're talking about combining high interest rate debts like credit cards into one lower interest rate loan. In this case, we're talking about a residential loan. So, again, we're talking about reduced monthly payment, a more favorable loan amortization, of course, as well, because those other cards that were at 28, 32%, you're going to be paying that card forever. And then we're also talking about tax deductible interest. Consumer debt used to be a tax deductible expense, but that deduction was removed many years ago. But interest on your home on real estate is still tax deductible. So that's an additional benefit there. Although do remember that the personal standard exemptions have increased greatly compared to previous years. But if the interest rate is enough, they're going to get a benefit there above and beyond their standard personal tax exemption. So debt consolidation, though, super motivating factor. Now, shortening the loan term, right, going from a 30-year to a 20 or a 15 or even a 10 years. We're getting some people reaching out to us. That's someone that really wants to pay off the home, is in a position to make a higher payment, wants to pay a lot less interest because as you shorten the amortization, the amount of principal that you pay within the payment increases greatly. Yes, the overall payment is going to be higher, but that's only because you're paying a lot more principal within each payment and paying a lot less interest. So definitely a much more favorable amortization table strategy desired amongst those that can afford it, that are looking to eventually pay the house off. They want to retire. They want to have a free and clear home. So shortening the loan term, big motivating factor. Now, what you're going to find right now, though, is right now, excuse me, right now we have an inverted yield curve. It's still inverted. That means that the short-term rates, like the Fed funds rate, for example, overnight rate, and the 1 month rate, the 1 year rate, are higher or just as high, let's put it that way, as say the 30-year rates, almost as high when you're looking at the bond curve. So the 10-year rate right now, for example, is still lower than the shorter term rates. That's why they call it an inverted yield curve. It's more like a shoehorn, like a horseshoe, excuse me, instead of an upwardly moving graph, which is normally the short term rates are lower, and as the term gets longer, the rate increases because of the risk. Well, right now, the short term rates are higher because the Fed is still actively trying to reduce inflationary pressures. And then home equity access, right? Somebody just wants to tap in on the equity on their home for whatever reason. Maybe they have it there. They say, my options are to tap into that money is either sell the home or do some type of a refinance, whether it be a new first mortgage or keep the first mortgage intact and just get a second mortgage, loan, HELOC, whatever may be their reason for doing it. But they're going to tap into the equity. Now, if you tap into the equity via a HELOC, you pay interest only on what you owe, right? That's the one benefit of the home equity line of credit. An ended mortgage, which means interest directly based on the balance. Or you could just do a HE loan, which is a closed-end second, or just do a new first mortgage to tap into that equity. Reasons to tap into equity: renovation of your property. Maybe you want to invest in something else. Maybe it's an emergency. Maybe you just want to take it easy and have some extra money in the bank now, work less, go on vacation. A lot of different reasons why somebody would want to tap into their equity. And that's what we, as a loan officer, need to find out in a nice, thorough discussion with our borrower so we can properly help them reach their objective. So once we've analyzed, we've communicated clearly, and we understand what is the objective, we've analyzed all the different benefits. Customer has made clear what's the purpose of the refi, and we've helped, and then we need to help them with an action plan. We need to make sure that we can properly guide the borrower through the decision on what product, what loan, and all the different components of the refinance. So our communication has to be honest and clear and open with the borrower, right? Remember, we are the licensee, they are not. So we are held to a higher standard and should definitely be able to assist the borrower with the data that we need to provide so that they can make an educated decision, right? We need to help the borrower assess uh, understand their financial goals. We discuss this, reasons for considering the refinance. We need to properly assess their needs. Again, guidance through the whole process because we are the licensee. We want to make sure we present those multiple solutions when possible. Don't just assume that because they came to you asking for an FHA quote that they're not interested in any other loan products, right? So give them multiple options, the conventional, the FHA, maybe there's an affordable product that's applicable like the Home Ready or Home Possible, or maybe it's non-QM, right? So make sure you analyze all the solutions possible, present them so the borrower can pick the best one. You don't want the borrower to think that you are limited in your offerings simply because you did not offer it or you did not mention it. All right, you cannot have your blinders on. And we definitely want to break down the costs, right? Highlight the costs, fees, potential savings, amortization, all the benefits that we spoke about is just the knowledge that you will need to provide the guidance to the borrower that's necessary so that they feel good about what they're doing and that they can reach their objective. And you definitely want to evaluate the risks to the transaction, discuss potential downsides, such as, for example, if it's an investment property and there's a prepayment penalty, 1 year, 3 year, 5 year, no year. You want to speak to them about that. Longer, shorter loan terms, potential negative amortization on adjustable rate mortgages, right? Because they may come to you and say, I want to get this arm simply because it's a quarter of a percent lower than a fixed rate. But is that really a good choice? It really depends on the margin, depends on how long they're going to have it. Maybe it's a 5 year fixed loan at a decent rate and they're only going to have the property for 2 years, 3 years. Just make sure that they understand once it becomes an adjustable rate loan, where is the fully indexed rate going to sit? So definitely evaluate the risks for your borrowers. So this is all about being the loan consultant, right? Remember, we're guiding the borrowers through the decision. We definitely want to prepare the borrower now, guiding them through the decision, so that they can decide on the product is not the last step. Once they've decided, yep, I like the conventional refinance at the maximum loan to value. Okay, that's great. Now, full speed ahead, but make sure that the borrower is prepared for the process. This is where you, as the loan consultant, are going to add maximum value to the transaction and avoid slip ups, right? Explain the required documents according to the guidelines of the chosen program. Real important here because you want to set the proper expectations. Guide the borrowers through the application process, including e-signing of the disclosures. Right? How many times has it happened? They lock themselves out of the portal thinking that the login and password is for another portal. So all of this are things in the process that you need to alert the borrower about to avoid hangups. Prepare the borrower for the credit checks, including running simulations. Right. Once you do have that credit check, you're going to run simulations to see if you can better the situation a little bit for them regarding the rate or the cost of the rate. Again, we're adding value to the transaction. Whether the rescore is done or whether the borrower decides, no, Jose, I can't wait, for a rescore. I need the money like immediately. That's fine. but you're going to offer you're going to bring up the discussion on the simulation again because we're adding value here to the transaction. Appraisals explain the need for the appraisal and the obstacles that may present themselves, such as property condition and reduced valuation. Especially if it's a refinance where, well, this is a refinance, but especially in refinances, that's what I meant to say, where you already know the property exists, make sure that you discuss with the borrower the condition of the property, make sure that the property is intact and in financeable condition. Uh, because if they want to do the refinance to renovate the property, well, are the renovations because the property is missing components that would render it not financeable, or is a renovation simply because they just want to spruce it up a little bit? Because it's not the first time that we've had a regular FHA loan. The appraiser goes out there and the property is missing the kitchen cabinets and the bathrooms are disassembled. Well, I mean, there's a solution for that. It's an FHA 203K loan, right? The renovation loan, which is for purchases and refinances, for example, but not a regular FHA loan that's going to require the property to be intact, just like every other regular loan. If it's not a renovation loan, if the property is missing components, stuff like kitchen cabinets, bathroom disassembled, or other glaring damage that's going to result in the appraiser making the appraisal subject to rather than as is. I mean, prime example, we received an appraisal yesterday on a cash out refinance. Subject property is a being refinanced out of a construction loan, and the appraisal came back subject to because kitchen cabinets still need the counters, baseboards still need to get put in, all of the electrical outlets need to be installed. It has just the boxes and the wires run, but none of the outlets installed, and other things like that. So the home was not ready. So now that appraisal was completed subject to. Now we have to redisclose a 1004D, which is a final inspection, re-inspection there. We got to make sure we redisclose that fee because now once the property is complete, we need to send the appraiser back out there. And then you definitely want to explain to the borrower what happens after the application is submitted, right? We want to make sure we don't run into any issues. Definitely we don't want them all of a sudden applying and buying a car, applying for credit cards, or all these other things that can result in an approval to be not approved once underwriting gets it. Maybe we do a credit refresh, and all of a sudden, new car payment, $700 a month, borrower doesn't qualify. You ask the borrower, what happened? And they're like, well, my car died and I needed to get to work. I needed a new car. And you could have said, well, you could have asked me. You got to let me know. Maybe you could have waited a week, right? So that's why it's so important to make these things clear to the borrower. Because remember, we're the licensee. We're the ones that know all these matters. Borrowers may not necessarily understand how these things can affect them in the process. So better to be proactive and to explain all this information to them. Because definitely we want to be able to close that deal. So once we do get the clear to close or getting ready to get the clear to close, you want to review and confirm the terms of the new loan and ensure that the borrower's objectives are met and that the borrower is comfortable with them. The last thing we want is for a loan to close a refi on a primary residence, and all of a sudden during the 3-day rescission period, the borrower cancels because it's really not what they were looking for. So you do not want to take it all the way to that stage just to have the borrower cancel. So you want to make sure that everything is clear throughout the process and that you confirm before you send the file to closing that the borrower is fine with the final terms. Discuss the timeline and disbursement of the funds. Again, real important, right? There's a rescission period. There's preparation of the closing docs. I mean, these are all things that don't happen in 1 hour. So we have to make sure the borrower has the proper expectations on the timeline once you have the clear to close for the preparation of the documents, the actual closing, and then the funding of the loan, right? Because they may have credit cards that have to be paid. Maybe the mortgage loan is due. The last thing you want to tell a borrower is, don't worry about it. Don't make your payments. It's going to be paid by the refinance. No, they would be better off making that payment and then having the payoff adjusted and sending the minimum payment to those credit cards if they're not going to be paid in time for the refi, because the last thing you want is for a bunch of late fees, and worst case scenario, late payments, right? If they go beyond 30 days, now you're going to have a string of late payments. That borrower is going to look at you, blame it on you. Look, at my credit is shot because you took so long. You didn't let me know I should have made the payment. And if they close that deal, they will never refer you another deal, which again explain how the loan will be paid off, right? And provide ongoing support and assistance throughout the closing and after the closing. Like I like to say, you want to delight them with your service and exceed their expectations, and you will receive many referrals and have a sustainable MLO career. The easiest deals you're going to get are referrals from past customers. Either they're referring you somebody or they're doing another transaction with you. So that completes the slides. I want to see if there's any questions from anyone here. I don't see any questions. Anyone have any questions on refinances? Any issues you've had with borrower refinances? Any weird scenarios that you haven't known how to respond to? This is your moment. The main takeaway from today's training, again, is adding value as a loan consultant. All right, so I see a question here. I saw on a matrix unlimited cash out for documentable purpose. What if they just want extra cash in hand or want available to purchase? Well, again, or want to purchase other properties. Well, that's a pretty open question there. It really depends on the guidelines, right? Yes, we have some guidelines that don't have a limit on the amount of cash out you get, depending on the loan to value. Others do. That's an investor to investor difference there. But what I will state is that depending on the loan type that you're getting, is what the refinance is possible for. So, for example, you would not be able to refinance a property into a DSCR loan if the borrower is looking to consolidate personal debt with the proceeds of that refinance, right? So, the business purpose loans purchase is for the purchase, obviously, of an investment property, and refinances are for either renovate the subject property, buy other investment properties, lower the interest rate. Three examples on acceptable reasons for a cash out refinance on a DSCR loan, but not to consolidate credit card debt, for example. That is not an acceptable reason. So that's the reason that's stated on the cash out letter on a DSCR loan. That loan will be denied because that's not an acceptable reason for the refinance. Now, here you go. Can you do a VA cash out refi on a free and clear property, right? We just had that scenario come up. And you cannot do a cash out refi, a VA cash out refi on a free and clear property. That's just one of those quirky VA rules in order to uh, be able to originate and close a cash out refinance on a VA loan. You have to be paying off a loan, right? And typically, it has to be paying off another VA loan. So, cannot have free and clear property and do a cash out VA refinance. Good question. And we just had that come up on the loan, and they had to switch the loan from VA, I think, to conventional. So, any other questions? Good questions there. All right, I'll give it another minute. Do appreciate everybody being on today for today's training. Hope you got some loan consultant tips and tricks out of it that'll help you get that deal, differentiate you from those application takers out there. All right. Can we do a refinance on a car lot business? Absolutely. That loan can be structured a couple of different ways depending on the use of the property. So we've already stated it's a car lot business. I'm thinking this must be a used car business or a new car business. I'm assuming is what we're talking about here. And now, if it's an owner occupant, in other words, if the owner of the business is the one that also owns the land, right? Owns the property, let's say, whatever it may be, a lot with an office and all that kind of stuff, and they're using it for their business, then and they're occupying at least 50.01% of the area, then you can do an SBA, which is a small business administration loan. So in this case, which was stated that it's a parking lot. Okay, so that's fine. If it's a parking lot and they're using that parking lot for their parking lot business, and the owner of the business is also the owner of the land of the lot, then you can do an SBA loan in that scenario. And if the owner of the property is not the operator of the business, you can still do an investment property commercial loan on that scenario. So then again, the main point here to consider in that scenario is the owner of the business also the owner of the real estate, or is the real estate rented to an investor? That's the key component there. If it's rented to an investor, it's a regular commercial loan. If it's owned by the business operator, you can do a small business administration, also known as SBA loan. And those SBA, well, now I'm going to back up a little bit. The SBA loan is not for cash out refinances per se, right? SBA loan will give you capital to build out your business, for example, build it up, build it out, stuff like that, but not a cash out in the sense of the cash out, right? Where the proceeds exceed what you need and you take it with you to do something else. That would only be possible under a regular commercial loan, which you could still do for owner occupants as well. That would not be SBA. That would just be commercial loan. And then the commercial loan, we can do owner occupied or non-owner occupied, and do allow cash outs. But SBA does not allow cash outs, but you can refinance to get working capital or improvement or expand the location. Great questions. I'll give it another minute, see if anyone pops any additional question in there, or else we will be good to go. Well, I do not see any additional questions, so I do thank you all for being in today's training, and look forward to being with you on next week's training next Thursday. Thank you. Have a great day.